Good morning, everyone, and welcome to our conversation starter, where we will be discussing how to invest offshore and specifically how we navigate unpredictable markets. We have an amazing lineup of speakers today. Simon Watts, Senior Portfolio Manager at Nedgroup Investments based in London, and Trevor Garvin, Head of Multi-Management at Nedgroup Investments based here in Cape Town. My name is Hein Klee, and I will be hosting you today. The purpose of this conversation starter is to engage with you, our clients, in an informal virtual environment where we can hold richer conversations following the main thought leadership webinar we held on the 25th of July, where we specifically focused on international investing with guest speakers such as Dr. Adrian Seville, which is a professor in economics, and Nikki Weber, our Nedgroup group economist. Just some housekeeping rules for the session today. Please use the Q&A chat box on your left-hand side to submit a question during the webinar. If your screen happens to freeze during the webinar, press the refresh button and it will take you back to where you stopped last in the webinar. You will receive an email in the next few days with a link to the recording of the conversation starter in case you would like to share or watch it again. Please remember you can get more thought leadership insights or previous recordings or webinars on our Nedbank Private Wealth South Africa website. At Nedbank Private Wealth and Financial Planning, we use our global integrated and advice-led approach to connect your financial decisions to your goals and aspirations. I think as we are in unpredictable markets, I think one of the biggest media comments that are currently coming out when it comes to the word risk is the uncertainty of inflation. It's also a topic we touched on the 25th of July. And what we are trying to do with today's discussion is specifically to show you as our clients how we actually manage your investment portfolios through the experts within our team. Your money decisions connect your goals and needs, dreams and fears, attitudes and the role you play in community to how you earn, save, and more importantly, spend it. That is what we call connected wealth. The fact that every financial decision you make is informed by and affects other aspects of your life. So these are all very interconnected and not isolated situations. Our global integrated advice makes these threats more visible and therefore more manageable. It also connects you to the solutions, services, and expertise that you need to make the most of your money and achieve your long-term success and goals that you are planning for. I'd like to introduce the panel, but before I do, we have three very special guests that I've asked to join our webinar today. Simone Nadir, Leslie Ann Shaw, and Lauren Rotseth, which is our team leaders based in the respected regions that we service our clients. Before I hand over to Sim just to introduce herself, as it is Women's Month, I did a little bit of research and I thought it might be worthwhile just to share the following with my three team leaders, the ladies in our offices, but also more importantly, the Nedbank staff, female staff that is scattered across South Africa and the rest of the African continent, and more importantly, globally as well. So today, as we celebrate the achievements of women worldwide, I want you all to know that your contribution have not gone unnoticed. You have shattered glass ceilings, overcome obstacles, and continuously strive for excellence. Your dedication, compassion, and resilience inspires all of us to reach for the stars and make a difference. Thank you for being incredible colleagues and for enriching our workplace with your remarkable talents. Let us continue to support and uplift one another as we collectively strive for greater heights. So ladies, happy Women's Month. Sim, over to you.
Thank you, Hein. Good morning, everybody. Thank you for joining. I'm Simone Nordia, and along with my team members, we are based out of Cape Town and look after the Cape region's international requirements for our ultra high net worth and high net worth clients. I have 17 years experience in this field, of which about 12 is at Nedbank Private Wealth. We appreciate you joining us this morning, and I'm going to hand over to you, Les, in Joburg.
Morning. Thank you, Sim. I'm Leslie Ann Shaw, and I'm the team leader for both Johannesburg and Pretoria regions. I've been in the business for around 20 years. I'm well established in the international team, and I'd like to hand over to Lauren in our KZN region.
Good morning to you all. Thank you for joining us. I am Lauren Rodseth. I'm based in the Durban office, where I look after 3 international specialists in our region, and I have been with the Nedbank Private Wealth International team for the last decade. I hope you enjoy the discussions today.
Thank you, ladies. Another quote that I saw yesterday, and I thought I'll bring this one in. I might get into hot water for this one, but it's a quote that was actually quite frequently quoted by Roosevelt, actually Nancy Reagan, Oprah actually quoted it as well. And they say a woman is like a tea bag. You never know how strong she is until you put her into hot water. So I think that's very relevant of unpredictable markets, what we've experienced in the last 3 years through COVID. So I think that was quite a nice fitting way to actually do that. So main speakers, Simon joined Nedgroup Investments in May 2012 as a senior investment analyst in London, focused primarily on fund research and portfolio management. Prior to joining Nedgroup Investments, Simon worked as a senior investment analyst at XL Group, a global insurance and reinsurance company within their investment management division. Further experience include work at UBS Investment Bank within the economic research department as an economist and strategist focusing on emerging European markets. Simon's investment experience and qualifications, he's got 25 years industry experience. He holds a BEc Honours in Economics, Masters in Business Administration, and he's also a chartered financial analyst. Our second speaker, Trevor Garvin, Trevor takes overall responsibility for Nedgroup Investments multi-manager division. This business covers the ongoing research and management of a range of South African and global multi-management funds. In addition, the division offers independent investment consulting and specific fund research for approved fund lists. Prior to this role, he served as a director of Edge Asset Management, following the merger of Edge and TMA Investment Products. Further experience includes consulting with Barra International and lecturing in economics and finance at the University of Cape Town. Aside from his overall managerial role, Trevor is actively involved in the fund management of both domestic and global funds and sits on both Nedgroup Investments International Strategy Committee and International Investment Committee. Trevor, also 25 years experience, holds a BCom Honours in Economics, a MCom in Finance, Master of Business Administration, and a Chartered Alternative Investment Analyst. I then hand you now over to Simon, and we look forward to your presentation. Thank you, Simon.
Thanks, Hein, and morning, everyone. I actually joined from a sunny UK, which makes a change, even though it is summer. So, yeah, all is good with the world. So, in terms of the presentation today, as Hein outlined, it's how we kind of invest offshore and how we help you navigate an unpredictable market. So in terms of, I mean, the markets, as you'd have seen, there's been a lot of noise and uncertainty at the moment. We have obviously geopolitical issues going on. We've got Ukraine, Russia, we've got Taiwan and China. We've got China and the US. And then even on the economic front, we've got, will there be a soft landing? Will it be a hard landing in the US? We've got, are we at peak rates? Will rates have to go higher? Is inflation coming down? Will inflation stay sticky? And then just in terms of other aspects, I mean, we've seen a pretty strong rally actually in markets so far year to date globally, but I mean, the US has been particularly strong. I mean, you could say a large part of that is being concentrated within artificial intelligence, related stocks. So it's been quite a concentrated rally. So we've seen many different aspects. I mean, even down to the fact that, I mean, we've had issues over the budget in the US. We've had US banking crisis in terms of regional banking crisis earlier in the year, and that led into kind of the Credit Suisse in Europe being taken over by UBS. So lots of things going on, and it can be quite unsettling. And in a sense, how do we navigate through the noise and uncertainty? What I would say, though, is noise and uncertainty is not really unusual. I would probably say that you could be more easily distracted by the noise and uncertainty at the moment, because we're in a kind of a 24-hour news cycle. You can see it on Twitter, or X as it's now called. You can see it on Bloomberg. You can see it on any kind of news channel now, where in the past you'd have to read it in the newspaper. So it is probably more prevalent and front of mind, and the amount of noise. So it probably seems like it is more noisy and uncertain than the past. But you have to kind of look back in history, and I think this chart here that shows you the kind of the returns over time, the returns pretty much over the last 100 years or so. And you can see the big events, obviously, that we've gone through in terms of the markets, and the amount of volatility and uncertainty that must have been around at that time. We've gone through world wars, the Vietnam War, Gulf Wars. We had, obviously, the September 11, Twin Towers. And, I mean, on the economic front, you've had the Great Depression. You've had the inflationary period of the 1970s. I mean, you've also had the more recent great financial crisis. So you've gone through Brexit. We're probably still going through Brexit. It's all these sorts of things that I think it's good to look back on and just say, look, actually, there is noise, but it's kind of like it's always there. But look at the markets, look at the returns that have been able to generate. If you've had a long-term perspective, if you've been able to navigate that noise, in a sense, if you've had that kind of, I suppose, risk appetite, but also long-term horizon. And you can see just in terms of that chart, you got the returns there that actually, I mean, equities over that period have returned, large cap equities at least have returned around 10% versus cash, which is kind of denoted by treasury bills, is about 3%. So kind of like an excess return of around 7% per year over that period. So it has paid. It's obviously a more volatile journey, being in more riskier assets, but it has paid to be invested over that time. And I think it's just investors have to accept this kind of noise and little level of uncertainty. I'll just say that there's two things that can really help you or help investors generally in terms of looking through and navigating that noise. And one of those is having a clear process. So having a clear, structured investment process, and that helps you stay focused, stay on target, stay in terms of your goals. In terms of having a consistent framework to be able to assess what's going on. Don't be attracted by the siren calls of the latest fad, or don't be convinced that everything's going to crash, because there's always in the news, there's always a reason to sell. So in terms of having a consistent framework is extremely important. And within what we do, we look at these kind of different factors and we decompose. This is critical. We decompose what's important. We try and look through the noise, look for the signal, decompose what's important in terms of risk and return. We have a team-orientated approach, so there's no egos driving it, no biases within the portfolio. So we just have a kind of a aggregate kind of team discussion in terms of how we approach the different investment classes. And what's important in terms of having a consistent framework is to do it on a repeatable basis. So having a look at it every month. So we have a formal process where we look at markets in terms of valuations, fundamentals, and sentiment, in terms of those sorts of criteria, and we look at it in the same lens through the same perspective every month So as I say, you're not attracted by these kind of like news or noise that might take you off in the wrong direction. The whole process is designed to kind of build conviction, manage risk, and diversify alpha. But I would also said there's another point that's really important in terms of, I suppose, staying the course, and that's having access to an investment team. And that's why we follow this team-oriented approach. I mean, there's a bit of Photoshop going on here, especially my picture. I do look a bit younger there, but it's obviously pre-COVID. But yeah, we have access to a kind of a broad investment team, a kind of quite a well-resourced investment team. So we've got 7 people in London, and we've got 4 people in South Africa. You can see Trevor there as well. But this is key, and this is the team that does all the asset allocation and fund selection. So it's having a dedicated team that is kind of trained to basically look at what's important. It is difficult. I mean, there is lots of noise, there's lots of uncertainty, but it is trained to look through that noise, look for the signal, and follow that kind of disciplined investment process. I mean, what I would say is most fund managers that you probably approached and talked to probably said just what I've said in terms of having a dedicated investment team and also a structured investment process. I would hope so. What I would say is our differentiators, and I'll just go through the 3 of those. One is that we're truly global. We don't have any home bias. We invest globally. So we invest globally. So in terms of equities, we invest globally. In terms of bonds, we invest globally. And so therefore, there's a greater opportunity set that we think that gives our investors access to. So as I say, we invest across asset classes and we invest globally. We have like the MSCI World as our benchmark for equities. We have the Global Ag, the benchmark for bonds. We invest in global real estate. We invest in kind of global real assets, etc. And broadly, that is our kind of like, in a way, opportunity set. We don't have any home bias, where some managers do have a home bias. They have a bias towards potentially the UK, etc. We don't do that. But what we do is we do control our currency exposure, and perhaps we can get into that a bit later on. The other factor that differentiates us is we are truly diversified. And as I mentioned, we are multi-asset classes. We invest across the different asset classes. We invest in equities, fixed income, real assets, alternatives, and also cash. On a kind of like in terms of region, as I mentioned just before, we are global, and no kind of bias to that. And then just what's important is as well is in terms of diversification across strategy and style. We don't have any kind of preference for active versus passive. We will look to where to best access that market, whether it be a passive vehicle, an index vehicle, or an active vehicle. We look at how we should tilt different parts of the portfolio within equities. So do we favor kind of growth stocks? Do we value stocks? And even within bonds, we look at kind of like where should we be in terms of, should we have a short maturity bonds, long maturity bonds, should be in government bonds or credit. And then obviously the next level of diversification is via our managers. And we obviously select managers, and we select passive vehicles or index vehicles. And that gives us that added level of diversification, but it also gives you access to specialists and experts in their field, which other managers that try and do it themselves don't. So we can access the best investment grade manager. We can access the best high yield manager. We can access what we think is the best, value manager in equities. And that's a real strength of this type of strategy. Not only gives you diversification, but it gives you access to specialist managers that are experts in their field, and that's what they focus on. Another area of differentiation for us is we think we've got a kind of truly distinct real assets and investments and alternative investments in terms of what we look at there. Gone are the days that we just invest in fixed income and bonds. I think you can achieve, there's a more wider opportunity set out there, and I think you can achieve much better risk adjusted returns, kind of by investing in typically less correlated investments. This sort of area does give you key characteristics. As I say, they typically are less correlated. They do give you, especially the real assets, they do give you some sort of inflation proofing. They give you some steady stream of income, again, on the real asset side of things. And this is where I'm talking about kind of commercial property and infrastructure. We get access to certain of these structures via closed-ended funds, which are basically listed funds, listed companies that invest in a particular area. And some of it comes also with the benefit that lots of the focus is on sustainable. So, I mean, we've listed here on the slide certain areas where these things come under. So in terms of the real assets, we look at commercial property, care homes, student accommodation, infrastructure, renewables. And real assets are essentially assets that look to keep up with inflation, and some have some inflation benefit within there. So their income streams do adjust with inflation. In terms of alternatives, we've got kind of asset-backed lending. We look at song royalties, we look at private equity, energy storage, and these are kind of all asset classes that act differently to your traditional asset classes, so fixed income and equities. So I'll just quickly go through 3 examples that we invest in terms of this area. First of all, global infrastructure. So we invest in Atlas Infrastructure, and as I was saying, we invest in specialist managers, and Atlas Infrastructure just invests in listed infrastructure stocks. So they invest in indirectly via listed stocks that basically are exposed to infrastructure. They are a specialist in this area. They're one of the world leading kind of investors in this space. They are partnered up with a global manager that invests in has about 100 billion invested in this space. Atlas itself, the fund is around 4 billion. So it's a concentrated portfolio. They focus, because of their expertise, they can concentrate, they can look for what they like, and they have a concentrated portfolio. They invest, as I say, across the infrastructure space. So they're investing in stocks listed on the stock market. They invest in such like utilities, such as electricity companies, water companies, telecoms companies, gas companies, but also in terms of transportation. So you've got airport, toll roads, railway. And this has been a real beneficial area recently. We do like real assets. It's been beneficial in terms of the fact that obviously electricity prices went up after the crisis in Ukraine and Russia. And it's kind of got this inflation linkage that has benefited the portfolio. So that's one example of an open-ended portfolio that invests in listed stocks in infrastructure. We also have an investment via Greencoat UK Wind. This is investment in UK renewable energy. UK Wind is probably the largest and the first kind of a company to invest really in this kind of pure play in terms of UK wind farms. So it first listed back in 2013, invests both on offshore and onshore wind farms. It benefits from not only the electricity price, but also the kind of the government subsidies that we have in the UK. And so it has a kind of very attractive and stable income stream. But it also benefited more recently from the increase in electricity prices. So that was beneficial when inflation was going higher due to higher electricity prices. And it's because of these kind of more stable cash flows, it can give you a nice current dividend yield of around 6%. So these sorts of investments, and this is via a closed-ended investment, so basically which is a company would raise capital and invest directly in these wind farms. They might tap the market again to raise more capital, and then you can trade it, so you can then buy and sell via the stock market. So really interesting strategies within infrastructure, not only just in the core, but also in the renewable energy space. We also have an interesting one in terms of alternatives, and this is, I suppose, you could say more recent one, but it's been music royalties. If anybody of you are into your music, it's a really interesting investment as well as, I suppose, a hobby as well. So it gives you access to song royalties, which are protected by copyright, and that's in the UK. It's basically 70 years of the death of the composer of the song. So if there was 2 composers of the song, it would be the death of the last composer of the song, so 70 years after that. So it gives you access to a stream of revenue. And the growth in this area has been really driven by the expansion in streaming. So obviously there was a point when there was a lot of piracy, but piracy in terms of songs, but this is an area that has now seen some very strong growth with things like Spotify, Amazon Music, Apple Music. So it's looks like potentially some very strong growth in terms of this area, but it gives you access to some interesting streams. Obviously this portfolio here, Hypnosis, was the first one in this space. It's listed in the UK, but it gives you access to these kind of differentiated revenue streams from the songs. They own, as it says here, rights to half of the top songs of the last decade. There's obviously different genres that it's diversified across, so pop, rock, R&B, etc. And what's important to factor in is also the vintage of the portfolio. Is it a young song? So potentially the income is more variable, but if it's a well-established, well-known song, then you can actually assess that actually that income is going to be guaranteed, and I can see it as a kind of an annuity every year. What they also try to do in this investment vehicle is they also try and increase the revenue of the songs by placing them in either movies or advertisements. So they can what is called syncing, and that's increasing the revenue via placement of these songs in different areas. So not only just accepting what the revenue stream is, but trying to grow the revenue stream. So that's another interesting area that we've been investing in. So if this is taken your interest, there's different ways that you can actually access the investments I've just described. We manage 6 risk profiles, and this is available on a segregated basis, but we also have 3 of those risk profiles on a unitized basis for the multi-funds. But yes, so it's according to your risk profile, we can accommodate different people and different time horizons, and also different currencies, so dollars, sterling, euros, with people with different base currencies. In terms of the ranges, we have the responsible range, which is our kind of, I suppose, the core range. It's responsible, we believe, very much so in investment stewardship, doing the right thing by investors. But we've also got the new sustainable range, recently launched. That follows more of a thematic approach within the equity side of things, but it also positively aligns to companies engaged in a sustainable change, and then also excludes more controversial areas from the portfolio. And that's managed the same way that we manage the responsible range. So our top-down approach, asset allocation, is very much the same way. The bottom line, the underlying holdings might vary, but the top-down approach is very much the same. Just lastly, on the sustainable portfolios, as I mentioned, is essentially it's basically trying to avoid the bad and align to the good. So obviously avoiding the bad is very subjective for everyone, but there are kind of like commonly accepted standards of what is kind of falling short of socially responsible standards. So things like landmines, gambling, weapons, cluster bombs, etc., etc. We're looking to limit that exposure, and we're using the MSCI to do so. And then on the other aspect, we try and align to the good. So we're trying to make sure that the portfolio is generating some really good outcomes. And so we wanted to have a kind of a positive alignment to the UN Sustainable Development Goals. And there's 17 of which kind of cover I suppose, some core areas such as climate, environment, society, health, wealth, education, and resources. So it's trying to avoid, as I say, the bad, but align to the good. So I'll stop there and I think now hand over to Trevor.
Great. Thank you so much, Simon.
Sorry, Trevor. Sorry,
Yeah.
just before you start, I just want to double check. I just got a message from one of our clients to say that the screen was frozen. So I just want to double check. I think it should be fine, but just from the technical guys, can you just double check that we are still broadcasting live to our clients and that we're not frozen? Thank you. Sorry.
All good. Great. Okay, I'm going to carry on. Stop me, somebody, if there's any issues. Good morning, everybody. Great to be here. And thanks, Hein, for having Simon and myself. As I guess Hein and Simon have alluded to, I am based here in Cape Town, but flirt a bit between Cape Town and London. And Simon and I have worked together and closely for the last 12 years or so, and pretty much form part of one and the same team. So great to be here. And I'm going to dovetail my slides very much on what Simon has discussed and set the scene for. And I guess I'm just going to put it a little bit more into a South African context. So if I just go over to my first slide here, I think this is really what Simon's also alluded to in his slides. And I've called it really the evolution of multi-asset portfolios. And this is very much how we go and approach putting together model portfolios or our fund solutions in terms of a balanced and across the whole risk spectrum, really. So traditionally, if you go back and look at the traditional asset management space, the old traditional multi-asset type of portfolio used to be made up traditionally of around about 60% in listed equities and 40% in fixed income or bonds. And for many, many years, that is what a traditional balanced type of portfolio looked like. Then we had, I guess, developments in the investment industry, and we had some of the big endowments in America, like Harvard, etc., many years ago, probably about 20 plus years ago, start investing into other areas of the investment industry. And we've sort of called those real assets and alternative investments, which Simon alluded to in the presentation. And I'll speak a bit more about that just now. So in terms of how we go about constructing our portfolios, I guess it is a little bit different to the old traditional balanced type of portfolio of 60-40 equities bonds. And now it's a mix of still these equities and bonds that make up the majority of the portfolio, but we have exposures to these other asset classes now called real assets and alternatives. And they make up around about 20 to 25% of the portfolios. Just how do you guys, as really South African-based clients of Wealth Management South Africa, and really the team that you saw at the beginning of Hein and his team of lovely ladies, you can access these really investments via 3 potential avenues. And again, Simon alluded to them in his slides, and I'll just briefly go through that again. So on the left is what are called the strategy solutions, or the actual UCITS fund of funds that are registered in Ireland. And we have 3 of them across 3 of the different risk profiles. So that would be an investment going directly into a single unit trust fund that then invests into a range of other underlying unit trust funds, and many of those funds that Simon spoke and covered to you in his presentation. The next one, which is probably where a lot of the South African investors within wealth management have been tending to use, are what we call segregated fund portfolios. And those are really very much mirror images of the unitized fund on the left, but what we would call unwrapped. So where you would go into the underlying funds on a standalone basis, and we tailor these models specifically for South African clients. And I'll talk to that in one of the coming up slides of how we go about doing that. So you own a range of different unit trust funds that we blend together across all the various asset classes, and one is able to actively manage that from an asset allocation and fund selection perspective. And then on the right-hand side, which is called separately managed accounts, it's very similar to the segregated fund portfolios. So you will hold a consistent asset allocation and you will hold a consistent underlying funds, with one small difference, which is you get a portion of your portfolio invested actually into a direct share portfolio that is managed by an offshore appointed share portfolio manager. So it's a mix of underlying funds as well as holding direct listed shares in a bespoke share portfolio. So it's a little bit of a mix of all of the above, and one can see as you start on the left-hand side, it's into a single multi-asset fund of fund. In the middle, you're investing directly into the underlying funds, and on the right-hand side, you're investing directly into the underlying funds, but with a direct share portfolio as well. So depending on your needs, on the size of your investment, what your preference is, each of these 3 options are available to you. I'm really going to just focus mainly today. Hein asked me to speak specifically on the SFPs, what we call them, the one on the left-hand side, segregated fund portfolios, and that was the middle block of what we just had up on the previous slide. So that is where you go into underlying funds directly that are very consistent with our overall portfolios and our house views. Simon did have a slide up showing that we have a range of different risk profiles in terms of these SFPs: cautious, balanced growth, income, and then growth and equity. So it's really across the full risk spectrum, and based again on your investment time horizon, your appetite for risk, your return objectives, you would be, with the assistance of Hein and his team, put into the appropriate risk profile and investment time horizons. So I'm going to focus really on these SFPs for the presentation. A little bit about these models, and these models are really put together specifically for Wealth Management South Africa, made up of Nedbank Private Wealth and Nedbank Financial Planning. So these models were launched in January 2017. So they have close to a 7-year investment track record. Just on that, in terms of our actual unitized multi-funds, where it's the full strategy solution, those have actually been around for close to 12 years now, and we have a track record that's really good in terms of those funds. In terms of our return objectives and time horizons, I'll talk to that just now, and it is on the bottom of the slide, which I'll speak to just now. How do we go about managing these models? It is via that process that Simon spoke to you about, which we call International Stratcom. It meets on a monthly basis. It is chaired by Simon, who presented earlier, or Tom Caddick, our head of investments in London as well. And I participate in that meeting along with other members of the team. And in that, we really come up with our fund and house view asset allocation. What we're trying to do as well is have total consistency in terms of these models and our house views, and have it across really all clients for wealth management South Africa. So there's consistency in terms of the underlying funds that we used. All of these funds go through a complete due diligence, both a quantitative and qualitative process. Again, Simon went through that in some of his earlier slides. And there's a team of 8 individuals in London full-time researching and doing the due diligence on these underlying funds. A small little nuance of these models is that what we have tried to do is tailor them a little bit for more what the South African investor and client is looking for. And we've tried to make them slightly more focused by holding larger amounts in less amount of funds. And of course, given that there are models held on Nedbank's offshore platform, it does create nuances in terms of the way you trade these, which ultimately have capital gains tax consequences. So that does affect the way that we manage these funds as well. We do not trade these funds and make changes on a regular basis, which would result in CGT tax events happening on quite often. We try and avoid those. So we manage these funds really trying to maximize investment returns, but also take into account the practical tax consequences for South African investors. And then largely for all of these models, we have a whole range of supporting documentation that many of you may have seen, where we have monthly performance figures, we have quarterly reporting, and all the information really that one needs to know about what is happening in these portfolios. So on the bottom, we have really set out the risk spectrum of SFPs. As we mentioned, on the very extreme, it would be holding just US dollar cash as an example. And otherwise, we have from income, balance, growth, and high growth, which really would be a full equity type of portfolio. What's important to note here are the time horizons. You'll see really it ranges from a 3 to a 7 year time horizon. Of course, cash on the left-hand side can be shorter. But in terms of the income fund, we're looking at, we recommend a 3 year investment time horizon. Once you get more to the balanced growth profile, we recommend more a 5 year investment time horizon as a minimum. And then once you go into purer equity type of mandates, a 7 year plus investment time horizon. What are the return objectives that we're trying to achieve? Again, it does differ based on your investment time horizons, but we have put them in there. So you'll see there for a balanced growth type of mandate, we're looking to achieve US dollar cash plus 2 to 4% real returns over and above that. And when you get onto the equity space, we're looking to get 4 to 6% real return over this rolling 7 year period above cash. So that's really where your wealth planner will assist you in trying to match your time horizon to your return objective, to your risk appetite. Just in terms really of how do we manage these funds and how it actually works practically. So I look after the funds, for Wealth Management South Africa. As I've mentioned, I work super closely with Simon and the whole London team, and we are all actually part of the same team. I've been involved in managing the offshore funds for the past 17 years. I sit on all the various Stratcom committees. We have weekly committees as well where we discuss and go through these funds. And so we pretty much are very much joined at the hip. In terms of the reporting that I've mentioned earlier, Most of that is done actually from London by the investment team. They have the various software tools. We have Bloomberg's and several other quant type tools that allow us to do look-through analysis of the portfolios, do the risk analysis, risk reporting, etc. I myself go regularly to London, sit with the team, and of course, we constantly having face-to-face manager meetings with all of the underlying managers that we're invested with. So, what does a typical model portfolio look like? And we've just put one up here on the screen. This is really our balanced growth type of SFP model. It's probably one of the more popular risk profiles where clients are investing into, which makes intuitive sense because I guess most people fall into this type of a risk category. So I think it just sets it out quite nicely, and you'll see a lot about the things that we've been speaking about, and I'll just highlight one or two. So first of all, from an asset allocation perspective, what does a balanced growth profile look like? So you'll see here, it has about 48% exposure to global equities. And Simon did speak to the fact that when we are investing into equities, we truly invest globally as opposed to having any specific regional biases specifically. And I'll touch on one or two things there shortly. From a fixed income perspective, we invest 22% into fixed income and bonds. Real assets, we have about 6% exposure to property via two funds, the Nedgroup Global Property Fund and BMO Commercial Property. And then we have 14% or so invested into what we've called alternatives or infrastructure and renewables via two funds. So you'll see there about 20% of the portfolio is in these real assets and alternatives, 50% or so in equities, and 22% in bonds or fixed income. So that talks to, I guess, that very opening slide of mine where I mentioned our portfolio construction differs a little bit from the traditional 60-40, where we now have real assets and alternatives in the mix as well. Just one other little thing perhaps to note, you'll see on the equity side, we do also make use of some passive funds. So we are a believer that there is a place for both active and passive management. We don't think one is better than the other. They each have a role, and we actually make use of both active and passive in terms of our portfolio construction. What you'll also notice is we have 4% exposure to the what's called the TT Emerging Markets Equity Fund. So that is emerging markets equities. That is a relatively low weight, as we've done that consciously in terms of being aware that many of our South African investors, of course, have exposure to South African assets and sometimes other offshore emerging markets. So we have tended to underweight emerging markets specifically within these portfolios, and I guess focus more on the developed market areas. In terms of the underlying equity managers, we have a range of active managers, and you'll see there we have Morgan Stanley, Dodge & Cox, Fundsmith, Goldman Sachs, and Veritas. These are all globally recognized managers, long and investment track records, strong research teams, and they're actually based literally all around the world. Morgan Stanley managers are based in the UK and America. Dodge & Cox is based in the US. Fundsmith is based in London. Goldman Sachs also, part of that team is based around Europe as well as the US. Our Nedgroup Global Property Fund is managed by a manager called Resolution Capital. They're actually based in Sydney in Australia. And for those of you who might not know, but Australian fund managers are actually known for being quite specialist and sort of global leaders within the listed property space. And then lastly, Simon spoke about the Atlas Infrastructure Fund. He mentioned what types of investments and the thesis for that. So you'll see there that we do hold that Atlas Infrastructure Fund within the model. Lastly, what I thought I would also just show you, you'll see here we have 22% into what's called the income multi-fund, and I thought it would be useful. I'm not going to go into detail, but just show you what are some of the underlying holdings within this income multi-fund. So first of all, predominantly it is fixed income, and you'll see in the slide here, the biggest weightings are in things like the Vanguard US Government Bond Index that makes up just under 18% of the portfolio, in iShares Treasury Bond that makes up 10%, and Wellington Global Credit Plus that makes up 12%, and iShares Tips that makes up 9%, etc. So the vast majority of this portfolio is in global fixed income. Again, you will notice we use a mix of both passive and actively managed fixed income underlying holdings. But then you'll see that a list of about 15 or 20 names that have all quite small weightings of around about 1%. And those are some of these alternative and real assets that Simon was speaking to in his portion of the presentation. So he was speaking about the music rights, and you'll see that there in terms of Roundhill Music, Hypnosis. You'll see infrastructure. You'll see our renewables, Greencoat Renewables, Greencoat UK Wind, which Simon alluded to, and also a small degree of private equity. So it is quite a nice mix of all listed, all liquid instruments within these asset classes, but certainly giving you some diversification. So I guess the question then also is, how about performance? And in terms of performance, I've just put it here. I'm not going to go into detail. It's quite a busy slide, but I guess if we just focus really on 2023 year to date, so these numbers are all in US dollar terms. So you'll see the equity model is up 15.8% year to date as at the 31st of July. So we're talking the first 7 months of the year. We sort of measure it against a similar peer group that's up 15.2%. And then remember our 4 to 6% real return objective above US dollar cash. That gives you a range of between 5.3 and 3.3. Our growth model is up just under 13% versus 11% peer. The balance growth is up 10.6 and the balance model up 8.4. So year to date, quite nice, solid performance coming out of all of these models. And you'll see there below it, we have 2017, 18, 19, 20, 21, 22. Those are the performance numbers since the fund launched at the beginning of 2017. And then I guess lastly on the bottom of the second bottom line, annualized return since inception. So that would be the average return per year since the funds launched just under 7 years ago. And you'll see there it's 9%, 7.5%, 6%, and 5%, which is ahead of the peers and in line with the long-term return objectives. And Hein, that's it from me. Hopefully that also just sets the scene and gives a little bit more information on the global offering. So I'll hand over back to you.
Thank you, Trevor. Simon, Trevor, thank you very, very much. I think we've got about 7 minutes left. There's a few questions that came through that I thought I'll ask you guys. Maybe we want to kick off, and I think we're privileged in the sense that, Trevor, you are responsible for both a product set in South Africa as well as an international product set. And Simon, in reverse, you are also responsible for a set of products in the UK, but also international. So I think we're very privileged that you both have that knowledge and product oversight. So maybe this question for you, Simon. The typical persona that we deal with is a South African living in South Africa, wants to externalize money, diversify his risk, and invest in international portfolios. But what we have seen over the last couple of years is South African residents financially immigrating and moving to the UK. So the process that you have explained, is there a similar product set that a South African moving to the UK typically can invest in that you have explained in that specific model?
Yeah, so Hein, just as I went through in the presentation, there's definitely portfolios that they can invest in terms of the discretionary models, and they can even invest in the unitized models as well. So they are available, and they follow the same strategy. They are global, and as I say, there's those pie charts I kind of outlined, the 6 risk profiles that we have on the discretionary side, and they're managed. Well, they take our recommendations. They manage by, essentially, they follow what we do in terms of portfolio asset allocation and fund selection. They very much closely manage that. They do also have I suppose, they are segregated versions of what we do in terms of the unitized portfolios. The added advantage there is they can customize it for clients' tax preferences as well. So there is kind of like an unconstrained version and a constrained version. So in terms of the fact that if you want to avoid any kind of UK assets, we can accommodate for that. So there's some flexibility there. And as I say, there is availability in terms of different base currencies, in terms of dollars, sterling, euro, depending on where your liabilities are, because you might have, I don't know, some liabilities, maybe children at university in the UK, or you might have a house in the UK. So you might want to have some a sterling-based portfolio or denominated portfolio, but invested globally, essentially the way we invest money across the board.
Okay. Thank you, Simon. Trevor, there's a specific question that came through from one of our clients that specifically said he noticed that the Nedgroup Investments multi-manager invests in some Nedbank or Nedgroup investment funds. Can you maybe give us an idea of typically what is the kind of funds that you would select as a multi-manager which is in-house, and an example thereof, please?
Yeah. So yes, you did see on that model that I put up, I guess, a couple of Nedgroup funds. The amount of Nedgroup funds that are held within the models will vary from model to model. They are very much in the minority generally, but I think the important thing to note is that they're actually all managed externally. So the Nedgroup model is one where we go and find and appoint who we think are the best managers in the world in those specific spaces. So and generally we try and look for boutique managers that are owned by the fund managers, as opposed to sometimes large sort of conglomerates. So I think I mentioned, so where we have a Nedgroup fund, it's on the property side. So that's actually, although it's called Nedgroup, it's managed by a Sydney in Australia based fund manager called Resolution Capital. Our global equity fund is managed by a company called Veritas, who are based in London. And lastly, the flexible fund is managed by a company called First Pacific Advisors, who are based in California in America. So I think people need to understand that it might have Nedgroup in the name, but actually we have nothing really to do with it. And they are managed by these global boutique managers who we've specifically found and researched and appointed to manage on these funds.
Maybe just a question for both of you. I don't know if we've got about 2-3 minutes left. One of our clients sent a question through to say he or she sees that we are not utilizing a lot of South African household names like a Orbis, a 91. Is there a specific reason for selecting international managers versus a South African manager that holds international experience or expertise?
Yeah, I'll have a go and Simon can add. I think just important points to note, and I think that person's probably making a fair assumption. It's definitely not, I wouldn't say anything intentional. We certainly have nothing against local guys, and I guess the main well-known local players would be a 91, a Coronation, M&G and Orbis. Those would probably be the well-known local ones. We have held some of those guys in the past, so just to note that. So it's really nothing definite, and we don't have a rule to exclude them. I think my other comment just would be to note is that those funds might not be household names, the Goldman Sachs Millennials, the Morgan Stanley, but they actually are all FSCA approved in South Africa, which just means that they have been approved from the South African sort of regulators. They can be invested in, and they're no different to the Orbises and the Allan Greys in terms of legal structure, regulation. They trade daily, etc. I guess it's largely a factor, and as we've mentioned, Simon and the team are based in London. We get exposure to both the South African managers and the global managers that are out there that are based all around the world. And it's just, yeah, through our screening process and our research, these are the managers who we've chosen. And as I've said, we have held Orbis in the past, and for various reasons, we had them for about 5 years, and we decided to sell out of them and replace them. We've held a 91 fund. So funds do come in and out a bit over time. As it happens, we get exposure to all funds that are out there across the world.
And then last question, then I think we need to wrap up. And Simon, I'm going to throw this one at you. What is Nedgroup Investments' stance on utilizing artificial intelligence software tools to assist with the decision-making of specific funds or strategies?
Excellent. Yeah, I think it's early days, but we are investigating how we can best utilize AI at the moment. I think it's more, yeah, a kind of a nascent area whereby we're using it. We're looking to see how we can use it more on the kind of, I suppose, efficiency side in terms of reviewing, writing up meetings, writing reports, etc., etc. I think in terms of looking at strategies and that thereof, I think that's still early days. I think what you have to remember is AI depends on data really that's already there. And in the investment environment, you have to not only assess the data that's already there, but you have to look forward and see how to interpret it as well. So you might have the best model in the world, but you've got to have some interpretation. So hopefully that means I'm still in the job in the next few years.
I think we all do. We all hope that. So, yeah. So guys, thank you very, very much. I'm going to just maybe close off. We're running 2 minutes over. It's just a reminder, once again, you'll receive an email in the next few days with the link of the recording of this conversation starter. There was a specific question also that came through from a client. How do they get a hold of us? I think if we use the contact@nedbankprivatewealth.co.za, and in your subject line, just put in the invest in brackets, and we'll definitely get in touch with you. I think the important part is if you send us the email, just basically tell us which region you are in, and we will then get one of the 3 team leaders, depending on where you are based, to get in specifically then in touch with you. I think more importantly, you will also see there's a QR code that's displayed. If I please can encourage you to do the quick survey for us. It's very, very important for us to ensure that we actually bring thought leadership in the future for you guys, specifically on your needs and requirements as our clients. I think also the topics that you'd like to hear specifically from us. So I think the important part, if I can just maybe summarize, I think there's a lot of unpredictability in markets. If I listen to Trevor and Simon, I think the critical part there is ensure that you align your long-term strategies with time. Don't expect a 20% return in a year, but possibly a 20% return over the longer term is far more predictable than trying to do it very, very quickly. The other critical part is that with interest rates on the up and where they are at the moment, a lot of our clients feel that's a safe haven for a return. But the important part is that cash over the long term do not outperform inflation. So I think the important part is once we've moved into cash, it sometimes becomes an easy haven to sit in, not understanding the consequences thereof by not outperforming inflation over the long run. The other important part for the South African investor is the money that you earn in interest are fully taxable at your marginal tax rate. By going into investment portfolios where there's dividends, cash, and roll-ups, it does actually alleviate and bring down potential tax liabilities that we have in the future. And I think lastly, you have a team of experts that has joined us today. More importantly, you have our staff members in the various regions as financial planners and wealth managers and private bankers that can get in contact with you, that we can engage with you. And I think when it specifically comes to the product set of what we have, we can really align your goals, hold hands and guide when there's a lot of unpredictability and uncertainty in markets. And that's where we are really the experts in what we actually call our connected wealth value proposition to our clients. Lastly, thank you very, very much. Go well and stay safe. Bye-bye, everyone.